Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Drew Meredith, how you going, mate?
Good. Good to be here as always.
Good to be here. We're recording remotely today. Well, I'm remote. You're in the office. How you going? What's news?
That maybe not everyone knows about, which is the halo light.
The ring light.
The halo light.
For anyone watching, so Drew
Jamie's
doesn't
always
squint this way normally.
Jamie always asks when I'm in this room, why the lighting, like why does everything look so good in this room? Because in our office, you've seen the lights that sit above it. They're right in the right spot, makes everything dark, and then you've got this. I'm pretty sure it's your halo light in here, isn't it?
No, it's yours. That's a $5 Kmart
It's a
ring light. For anyone that wants to become a famous podcaster or YouTuber like say Drew here, you can go to Kmart and get a $5 ring light. It just plugs into your USB, good as gold. They're fine, actually. They're actually pretty good. I take one on the road with me. But what have you been working on, mate?
A bit of everything. A lot of news this week. Head down to the Super and Wealth Summit, the AFR event, which was across the road. You probably remember our team just had the ESG retreat down in Tassie as well. But the AFR was super interesting. They had all the big industry funds there, IWF, JB Weir, AMP, all the big names talking about kind of advice, retirement. The Minister, Stephen Jones, went pretty hard at pension fund industry funds on how they're not doing enough in retirement. And
what does
Wayne
it mean by
Swan
that?
kind of talked about they're not providing retirement outcomes and they're not really educating. I think there was a stat that came out that 40% of people, which is probably it's a ghoulish name tag we've got there.
It's Halloween,
sorry.
Happy Halloween.
for everyone, you've got some name badges came up, look like Halloween. There's something like 40% of retirees are financially illiterate, which was kind of a shock, but they're not that shocking at the same time. So as they're not really educating and people aren't empowered when they get to retirement, they basically just get a letter that says change to an income or you're retired, here's your money. And that process isn't very clear, nor is it providing them with awareness of how much they could draw. One big thing, we ran our retirement event last week too for Wattle partners. Yeah. And one big thing is this kind of minimum drawdowns that you have 4% under 65, it goes up every year. People see that as how much they should draw, which is the complete opposite. You should be drawing, one, what's sustainable for your assets, but two, what you need to live, not what the government says is a minimum amount. That was, I think, a big message that came out of it too, and that's just empowering people to know their financial position.
So, in other words, because the limit is the minimum is set at 4% at 65, from them saying, people think, well, 4% at 65.
Yeah, they think that's all they should draw. Where it's complete. Depending on your assets, you should be trying to live the same lifestyle that you had before, if possible, and then adjusting accordingly, not just spending the fall that comes out and not thinking about it anymore.
Yeah, fair enough. I think this is like something that we see. It's like financial literacy or investment literacy. It has nothing to do with age. Like,
not at all.
I can see this in the crowds, no matter where we go. Like, it doesn't matter if we're talking to a not just retiree community, but a very old, say, stock picking community or younger investors at some sort of evening drinks or whatever. At the end of the day, the reality is like it doesn't really matter how old you are because we're not exposed to financial education and investment literacy. So we're not seeing it at any point of our life. So why would we think that age is a reason that we are more educated on that?
I think that's why podcasts have exploded in the last few years as well.
Yeah, and I think that's why so many people who listen to this are over the age of 50. Like you would think that we use like primary colors like yellow or blue or green at Rask, that you'd attract a younger audience, but it's just simply not the case. Like most people, the average age of our podcast is
younger people like primary colors.
Well, but that's where the kind of like the psychology behind the choice of colors for like Microsoft and Google and all
Yeah.
those things come from, is that you have primary colors because it's less offensive. You learn primary colors in primary school, right? So, like you'd think that, but the average age of listener of this channel is 49. So,
Yeah.
it goes to show that it doesn't really matter if you want information and you're interested in investing. It doesn't matter what age you are, you want to learn. I'd say that the people that listen to this, in fact, I'd be almost sure of it, are not the people that fall into IOF's definition of financially illiterate, because we
Yeah.
are listening. There was something interesting before we get to the news. We did hear from Kogan this week.
You're getting a bit of what's the word? Gravitas.
Gravitas.
Oh, and I'm pretty sure you've got some gravitas in there.
Gravitas. I don't know about that, mate. I'll take it. It's better than
Credit to you for that. Free
credit. Thank you,
TV.
sir.
Let's not jump forward though. Yep.
Yeah. No, there was a section in the notes that you prepared for this week, which I thought was really interesting. And it's while we're on the topic of retirement. You have some notes here for folks who are heading into retirement or in retirement, a bit of a spring clean. Do you want to run us through these 6 things that you've come up with?
Yeah, I'm a really weird note taker. So you know the notes thing on your iPhone, which then goes to every Apple thing you have. If I just come up with random ideas, I'll put it there. And it was basically someone wrote about a spring clean. I'm like, oh, that's perfect. You should spring clean your portfolio or spring clean your retirement strategy before Christmas. Everyone thinks about it after Christmas, and that's when we get a lot of interest naturally because you're thinking about it. But there were 5 things I put together pretty quickly, which kind of span investment and the financial super side. So something we found, or we talked about at the retirement event, was that something like 80 or 90% of SMSFs over 65 have commenced a pension, which turns their fund into tax-free. Something, I think it was less than 10% of industry funds with members over 65 have done that. So just something as simple as that can save you a massive amount of tax. General advice only, depends on your situation. The other one's check your transfer balance cap. So whether that's whether it's your pension cap or your ability to make catch-up contributions, go onto MyGov, look at your super cap for the last and where it sits for the last few years. You've got some benefits if you're under 500,000, and then the other one's been increased to 1.9, as we found out.
As we found out
last week. And then more investment ones, and look at your asset allocation. You know, markets have moved a lot. Have you become overexposed to something more than something else? Like global shares have done much better than Australian, so just be wary of anything popping in. What are you getting on your cash? So Jamie's been published, Business Partner's been published a few times the last few weeks. Go buy term deposits. Not personal advice, but make sure your cash balance, whether it's on a platform or not, is near that cash rate, which should be over 4%. Or if it's not, start looking at term deposits. And then just looking at your contribution caps. You don't have to do it. We all do it in May, but you can think about it earlier.
Can you walk us through that? Strategy. What do you mean?
So the ability to make non-concessional contributions each year. And we tend to think about it because it gives a structure in May, June. But just because it's the end of financial year, you're free to make those contributions whenever you like, which is you can make $110,000 per person in any given year. And then there's also strategies like you can draw out your super and recontribute it with a view to reducing the tax for your children. All legal and not
loopholes.
Tax avoidance.
Yeah.
But think about those sort of strategies for those. Some of them are for over 65. Some of them are for people probably in accumulation phase as well.
Yeah, they're great. Maybe we'll include that list along with the show notes today.
I was going to try and do a quick article on that too, so we'll see how that goes.
Okay. Well, if you get that out in the next 24 hours, let us know and we'll chuck it up on the website. No pressure. So we did mention that I did buy a Kogan TV not too long ago, and I feel like it got right to the end of the warranty period and then started to freeze and turn on randomly throughout the middle of the night. So Kogan reached out and said, hey, we're sorry to hear about this on the podcast, but let us know if you can try these steps and fix it. Kombucha, there you go. Drew.
I also love Remedy kombucha.
So if you do want to send Drew some kombucha, I'm sure he'd appreciate that. Drew at Wattle Partners, of course. So Kogan reached out, and thanks to the team there that did that, they told me some instructions to follow, and it fixed the TV. So presto.
I thought you were getting a new TV.
No, they offered that if it didn't work, they would send me a new one. But credit to them. They found a solution and it fixed the TV for me. So now I can watch my favorite Amazon Prime things when I'm jumping into bed for a little while. So
We
thank
have
you
to
so
thank
much,
July
Drew.
as well, don't we? From a few
We've got to
weeks
thank
ago.
July. Shout out to July, the luggage company, based in Melbourne, makes wonderful luggage. So don't get an American Tourister, get July. Not paid to say that, but that's
Not at
the
all.
plug. Not at all. Drew, do you have a buy, hold, sell for us?
Yeah, I had a weird buy, hold, sell for you.
Okay.
I always come up with them at the last minute, and most of them are personal and not stock driven.
Okay, I like this.
My first one is price of petrol. Buy, hold, sell petrol cars. Maybe it's on a medium term basis.
Medium
It,
term, so with
it
3 to
costs
5
like
years?
it cost me $130 to fill up my car the other day.
Yeah, shit. Are
Yeah,
you saying, when you say medium term, what's your definition of medium term?
3 to 5.
Okay, yeah, me too.
Did you really buy a Tesla?
Yes, I would say sell combustion engines. I think if you're a tradie, you probably can't get away with electric just yet. If you're driving long distance, like into the country, you probably can't get away with a electric just yet. But everyone else could drive electric. It's
Yeah.
they're so much better. So yes, shout out
The
to
range
Rodney.
on my car is like
Actually.
600 kilometers, and the range on a Tesla is 600. And they always talk about the range being
Yeah,
more.
depends on the Tesla. Like mine gets about 450, but how often do you go more than 450 in one shot? And around the major cities in Australia, you've got all the superchargers. You get 80% in 15 minutes, so
Yeah.
it's not too bad. But yeah, I can't remember the last time I stopped in a bloody petrol station. So maybe to get fishing bait. That was probably about it, to be honest. But yeah, I would say sell. But I was thinking you're always going to need diesel trucks and that sort of stuff for certain long range applications and whatever. So that's my one. What about you?
I'm still a buy.
You're a buy on combustion engines. Okay.
The sound of an engine just sometimes is nice. I do want a Tesla. I'll be buying
Well,
an electric next.
I was talking to David Dicker, the founder of Dicker Data, the other day.
Is he
It's
the
a
one with like
podcast.
7 Ferraris or something?
Yeah, he's got heaps of Ferraris. He's got his own private jet. He's an interesting fellow. He's actually appearing on the podcast in the next 2 weeks, so that's an epic interview. But he was saying the same thing you're saying about, pardon me, about the like the sound of the cars.
Yeah.
I actually like the sound of an electric car taking off. Kind of sounds like a jet taking off. It's kind of cool.
I hate that you could be trying to cross the street in like a weird neighborhood or the burbs of Melbourne, and you can't hear the Tesla. Like you walk out.
Yeah. It'll clean you up. You don't want to get in
Look
front of
both
that thing.
ways.
Yeah.
That's what we
Okay,
should
number
do
2.
anyway. The second one was kind of follow up. We had CSL last week, hit by the GLPs and Ozempic. So this week's ResMed. I know Dunkin' Donuts has had an issue as well, that now people are saying because of lower levels of obesity that people will stop eating donuts because of these treatments.
Wouldn't they eat more donuts?
I think, well, maybe it's supposed to reduce your appetite, so I'm not sure. But maybe you eat donuts and you don't eat other things. Who knows? But we're not doing Dunkin' Donuts, we're doing ResMed.
Okay.
So the ResMed makes sleep apnea products.
Devices. I'd say buy.
Yeah, I'm a buy on that too.
Yep.
Not the best at buy, sell, hold, so I'll put myself out there for that.
No, that's right.
But,
I like it.
the
Finally.
last one's the beautiful game. So we had the Matildas last night playing another Olympic qualifier in Perth, winning again. Buy, sell, hold on the beautiful game, whether that's soccer or women's
Football.
soccer or football.
Football. It's the one you play with your feet, so football. I would say buy.
They're all buys.
I'm a huge soccer fan.
Well.
I'm a huge soccer fan, so like I love my Chelsea and love watching soccer. It's what I watch most. So I would say buy.
I'm Man United, so I hate that soccer, but I love watching the Matildas.
Okay, so it's a buy from you.
It's buy, yeah.
So we've got buy. You got buy. I've got sell on the petrol. Buy.
Please send through some other buy, sell, holds for us.
Yeah, please help us out. Please help us out. I do have a couple of hypotheticals for you, actually. I was going to say, what's the one or two? I'll give you one or two. What's the one or two best non-financial investments you have made in the past year? So something that's not like a investment product, like a share or an ETF or a fund or something like, not a bar, not a real asset. Just something that's like maybe like a product or could be whatever.
The car I bought from my parents, I kind of, for some reason, find some joy in that.
Okay, that's good.
Like you do spend a lot of time in your car, so it's kind of
yeah, fair enough.
Comfortable. And I did not prepare for this one at all.
Okay. Well, I think
think
go for it.
Bringing like this is going to sound stupid, but like bringing structure to your day or life, which I know it's more like how do you structure things and how do you organize things better, and kind of freeing up time and mental space that way, if that makes sense. So I don't use motion or anything like that, but compartmentalizing your day a bit better. Maybe that's a bit too deep. I usually go shallow and happy. This is going deep.
No, well, investment in. I got asked the same question this week for a book. So, like, what's the best non kind of financially thing that you've ever made as an investment? And I was like, oh, well, I guess like investing in things like mental health is really important.
Yeah.
Like, I think that's really important. I think people underestimate like the best earning asset that you have is what's up in your head. So you want to take care of it. But I would say most recently, I bought a Costco membership, which I'm stoked about. Like, I'm absolutely thrilled about that.
Again, every week. And you paid for it, not an ad. Let's be clear.
Yeah. And then the other thing, I bought a copy of Mike Kemp's book. Michael Kemp, who worked with the Barefoot Investor for a while. His book is the Ulysses Contract. I know a lot of people that listen to the show have got a copy, and I think it's a brilliant book. I think it would change a lot of people's perspectives on various
I saw this
forms
one
of
I was going to
investing.
try and read out too.
What is that? Gonzo Capitalism. I have heard of that.
Yeah.
You haven't read it yet?
No, I just saw it online today. I'm like, oh, that looks interesting.
This is more of a public service announcement for folks as well. I've also booked in, hopefully, I'm guessing it will go ahead, Shane Parrish from the Farnham Street blog. He's got a new book out, Clear Thinking. So his podcast with us will go live before Christmas. So if you do have any questions for Shane Parrish that you want to send in, please let me know. So to put it in perspective, Shane Parrish is probably at a similar ilk to Morgan Housel. So his book is currently on the New York Times bestseller list, right up there with Atomic Habits and all that sort of stuff. So, in fact, on the back of the book, I noticed I got a copy. My copy finally came today. I bought 2 copies and an audiobook because I forgot I ordered the original copy, and it took 4 weeks to get to me. But on the back of the book, there's Annie Duke, Morgan Housel, and a bunch of other people that have basically endorsed the book, and it's a fantastic thing to see. So those would be mine. The other thing that I wanted to ask you is just a bit of trivia. This is more a bit of like pub trivia on a Wednesday night for investors. What's been the best performing stock market since the year 1900?
Only one of them's been open since then. Has it been the S&P 500?
No. Australia's been in business.
It's not Australia. Stock market like index?
Just pick a stock exchange then. If you pick a country.
Not the New York stock, US.
No, that's third.
Canada?
No.
FTSE?
No.
Hang Seng.
No.
Well, you're going to tell me it's the ASX 200. No, it's 200 only created in the 1980s, the All Ords.
The All Ords would be the one that you track, goes back. The All Ords is the second best performing stock market. The best? Johannesburg.
Johannesburg
South Africa. Yeah. South Africa.
A lot of similarities to Australia too, yeah.
Yeah. It's a kind of like back then it would have been like an emerging or a frontier market. And it's developed into a developed market, which has probably helped the country and the stock market rally over time. But yeah, the US was in third, Australia second, Johannesburg or South Africa in number 1. So do we have any other news we want to get to before we answer some questions?
Always a lot. We've got a rate decision coming up on Tuesday. I'm saying it's going to be a hold. I think 80% of people are saying it's an increase, which I find incredibly challenging. The Federal Reserve kept rates on hold this week. That's why the markets rallied overnight. I'm just rattling them off here. The IMF came out and blamed the government for inflation. Do you see that in my notes?
Probably fair.
All this infrastructure spend, and I think we've talked about this before, and it's what Bill Mitchell talks about. We have to confirm his date as well. We're just treating this as if it's a normal chat, not necessarily a podcast. But basically, the inflation comes when there's crowding out by the public sector into the private sector. That means that the public sector is using up too many resources and pushing the economy past capacity. And the IMF, so International Monetary Fund, has said that there's too much government spending on infrastructure and it's dragging resources out of the economy, which is sending the price of them up. So that's a big contributor to inflation and to labour, as well as naturally the imported oil and kind of related commodity issues.
Yeah. Yeah. It makes a lot of sense, right? Because I mean, I was chatting about this earlier on the finance podcast, is that we do have an issue where uh, retirees in particular are able to spend and because interest rates have gone up. So then we don't really have the impact from that side of the town yet. We're seeing the impact on people with mortgages. Most of the household savings rates come way down. And so for the most part, like there's been a lot of stimulus going into the system, which is keeping unemployment super tight. Um, I would say younger households as a general rule are feeling the pinch a lot more than the older households. And the government is on a spending spree. At the same time, the RBA is trying to hold up rates. So it's kind of like there's all this tension in the system. And I'm with you, Drew. For next week, I think it will be a hold. I just think there's too much water still to go under the bridge from the or interest rate increases we've
Could be
already seen.
higher rates that could be contributing to inflation because they're giving retirees more money on their term deposit.
Well, that's
They're
it.
spending it
Exactly.
more.
Exactly.
Yeah, the people who own capital, and I think there were some stats out of the US that like national wealth, household wealth is even median household wealth is the highest it's ever been, and that's why it's having less and less impact. Because if you've got financial assets and it's not all in property, well, your income can actually be going up.
Mm,
Um,
yeah. So I guess it's one of those things at the end of the day where folks just need to be mindful that we might have persistent inflation or at least persistent rates near where they are. And as you said, if Jamie's right from earlier on, he's telling everyone to go out and get term deposits, well, and savings accounts. There's no reason to stop spending if your interest is exceeding your cost of living. Why not?
exactly.
Any other news? 4 questions.
We had, Eurozone inflation. I'm still pushing for this. Is under 3%, so inflation is falling in a lot of places. I was at the AFR summit. They talked about Australian super, so they just pushed back on the bid for Origin to take Origin private. I'm not sure if the stock could cover that much.
No,
Big,
no.
a lot of renewable energy, but also biggest coal energy producer in the country as well. So it's an industry super fund refusing the price that they're offering and trying to get a higher price out of the bidder.
Interesting.
And then most of the groups saying that Origin don't have enough money to invest to this level they want to without this deal. So that price of that deal went up overnight to $9.50, I think from $8.80 or thereabouts.
Wow. That's a pretty big increase considering it's just like one blocking stake. So I guess Australian Super's got a pound of flesh from that then.
I'm sure they knew it beforehand too. I assume that's how it works. You know what the price is going to be and you keep pushing for the next one.
Yeah.
Not that there's anything.
No, there's nothing nefarious going on there. Yeah.
But this is another company, another major Australian company taken private. So you're seeing the value of, and I think there's a question about value of currency, that with the Australian dollar so weak, all these takeovers are actually, cheaper for overseas companies at the moment. That's why in the mining sector in particular, there's a lot of interest.
Yeah. The only other thing that I saw from your notes, I might say, is that Domino's Pizza expects earnings in fiscal 2024 to be significantly higher as it restructures the business, and the company told its shareholders at the AGM.
Something like 7,000 stores or something they wanted as well. Like, it's a lot of pizza shops.
Yeah, they've always had very aspirational outlooks.
Rollouts. The key there, like sales are up 12% year on year. That's like at any level, that's impressive.
Well, it wasn't that long ago when folks were bashing on Domino's saying that, it's basically dead and COVID and blah, blah, blah. So stock has fallen from $159, $160 a share. That's in late 2021 to $51 today. So it's back to a price earnings ratio of 67, doctor. So that's basically a growth. It sounds like a value stock. Pretty Xy still on those conventional metrics, but it has got a history of growing and being a persistent grower. So I guess that's a pretty good thing. Just a quick question. I did ask you this last week, I think. What do you reckon about Wattle Partners going on the road in 2024? I'm going to catch you off guard here.
Well, we're recording on Thursday, and me and you have a meeting planned tomorrow morning to talk about this topic.
Yes, we do too. So maybe next week. So just watch this space. Is a bit of a tease, is it?
Watch
this space.
take this retirement community national, and that's what we're trying to build. Really, is a community of not like-minded, but people with a lot of things in common.
Yeah, we got there.
Not an ability to speak, but we are talking about it next year. So how we can, even if it's quarterly, offer some one-on-one meetings at the same time as running a retirement event like we did last week. So we had a
Yeah,
retirement coach. We had yourself, me, and Jamie talking about more financial strategy matters, and then we had some fund managers talking about the investment side. Hopefully, we got a bit of a blend. Okay,
Yeah, I think
between
it
the
was
three.
great. I think all of the speakers did really well, and John Glass is a great speaker as well. For anyone that
Chow
came
Ma
to the
from
event, you
Cooper,
wouldn't.
from
Yeah, yeah,
Munro, she was
she's
exceptional. Yeah.
brilliant. Yeah, she's brilliant. She's brilliant. Okay, so we got some questions sent in. If you have asked a question, or if you do want to ask another question, you can head to the link in your podcast player or in the YouTube description below the video that says ask a question. Select the Australian Investors Podcast. Drew and I answer the questions every Saturday morning. Just remember that it is general financial information only. We don't know your personal circumstances, which is why we ask you for silly nicknames on the way in. If you are the silliest name of the week or the most fun, you end up with a prize, which is the Value Investor Program, a free online course on value investing worth 499 clams. With that said, Drew, the first question comes from Tassie Tiger, and I don't know much about Pact Group Holdings. Do you?
Yeah, Jaminda Pratt family. I think Jaminda was the Pratt family, isn't it?
Yeah,
So the
and
Pratt family owned Amcor and Visy.
Yep.
Anyone that knows Alphington with the old paper mills for a long period of time, and I think Pact Group does more specific packaging.
Yeah, right.
To my mind, rigid plastic and metal. So it was kind of like Aurora would be one of the other companies that was involved, and I think they do more of the cardboard, and this is like the plastic and specialized part. So
right.
highly labor intensive or input intensive, probably thin margin business, and probably a SMID cap.
Yep. Okay. And do you cover the stock that closely?
No, we've covered Aurora in the past, not Pact. I think mainly due to the size.
Yeah.
I could be proven completely wrong on that. Oh, yeah, Pact is only a 250 mil market cap, whereas Aurora sits in the ASX 100 from memory.
Okay.
It's 3.3 bill. Yeah.
Okay.
So know the
Tassie,
family, know the history.
yeah. So Tassie Tiger, I don't cover it that closely, neither does Drew, it seems. So we might have to take a pass on this one, mate. But a great question about the potential takeover. I have seen it in the news and all these types of things. Takeovers are the flavor of the month. Sorry.
Take private too. So it's Raf Jaminda trying to take the company that he was running or majority shareholder of private, and then the independent board recommending you don't accept the offer.
Yeah, right.
So
Yeah,
really what he's saying is that the share price isn't valuing the company highly enough, and management at the moment isn't doing enough to just in the kind of the story for most of these, that management isn't doing enough to show that value.
Yeah, right. Fair enough. This is a good one from Baggins, T Baggins, in fact. Writes in and says, how does someone who is not a sophisticated investor invest in a private credit fund? What are the options? Because they may be listening back to some of the other episodes that we've covered before where we've talked about private credit strategies. What are the options if someone is not a sophisticated investor? Are these available, quote unquote, to retail investors, Drew?
I think private credit is is it worth defining wholesale and retail investors as well?
Yeah, probably.
So wholesale investor, you basically need to be earning an income of over $250,000 or have assets in excess of 2.5 million. And then you get access to these big range of investments. The big advice wealth management groups use this to distribute different kinds of investments, and it removes all that, like your retail license. It removes a lot of the protections that you have as a retail investor. So we treat everyone as a retail investor at Wattle. And it's really the investments that are generally popular here are private markets, the potential higher returning, so like private equity, venture capital, and perceived high risk, and these investments that industry super funds and other groups tend to hold. Private credit itself, I think, is quite difficult to get as a non-sophisticated, if that's even the word, the amount of sophisticated investors we've met. Like money doesn't determine your financial literacy.
No, just like age,
which is the issue. And we've talked to regulators about this as well. There are options to get an exposure to the credit sector, I think, which are quite interesting. You've probably interviewed a few, like Metrics
Yep, metrics.
would be one. There's Revolution. I think that's Bob Sahota. That's
Hmm.
the Channel Capital Group. There's
Invesco's
like
got the senior secured loans.
senior secured, so it's not private credit. It's still kind of traded in the background. But basically what you're trying to do is get exposure, and this is a very important discussion at the moment. Rather than buying equities and buying more ASX listed shares, you're going from the equity part of a balance sheet to the debt part, and that's all private credit is. Usually private credit is usually in probably smaller and private companies versus listed ones. So there's a lot of listed alternatives, Neuberger Berman and some of those listed products that are giving you credit exposure. But I don't know of any private credit specific for retail, if I'm completely honest.
Yeah, I mean, there are variations of like a lot of people ask us about QRI, which is the Qualitas Fund, commercial real estate. And there are these other types of strategies. I mean, the Invesco website's probably a good place to start. There are different strategies that are available, but for the most part, they are wholesale or require large minimums
Yep.
for investments. And I think the question is like kind of like what are they trying to get out of it? And in this instance, don't know who you are, but you may be looking at say something like a defensive alternative. And I think they go on to say, I've read it that this investment would sit well in bucket 2 of the 3-bucket retirement strategy. Love the podcast and would be keen to hear views. Yeah, so I'm guessing, Drew, that something like this would sit in your defensive alternatives. And the idea would be to inject this into a portfolio so that you get a higher ongoing yield, probably not the capital growth that you expect, but a higher ongoing yield, probably in the high single digits, low double digits.
Yep.
And effectively, many of these would be floating rate, if I'm not mistaken.
Yeah, well, actually, just walked out of a meeting with KKR, so they're probably an example of a credit provider. So KKR is the biggest private equity firm, but they also do debt, not just equity. And the income is just like when we look at portfolios now, we know you can take less risk and get the same income. So you're taking a little bit less risk than equities because you've got some security over the assets of a company, but your yield 8 to 12% income. And most of these bonds that you can buy are trading at below their $100 par value. So you could have some upside when they're refinance or they mature. The issue with private credit in retail for retail investors in portfolios is that it generally requires you to not be able to redeem it. Basically, it has to be illiquid and not always comfortable, or it means you've got less flexibility.
Yeah. But the yields on offer from these types of strategies can be meaningfully higher than a traditional bond fund. And sometimes they do have less volatility as well, which is quite interesting. So a lot of people think it sounds like a pretty like dark side of the moon kind of thing where you're going, but it's not that bad. Like if you invest with a reputable manager, of course. I guess the question that we could probably ask here is like floating rate versus fixed rate. If interest rates fall, obviously you don't get as much yield from that. But and whereas a fixed rate, you would get the uplift in the value of the bonds. So I think it's a matter of just blending the two right now. The next question, Drew, comes from IP Freely, who has written in before. It says, is it worth considering?
Same IP Freely, or
It's probably the same IP Freely. Is it worth investing directly in US shares given the poor exchange rate of the Aussie dollar? Wouldn't my gains be eaten up at the moment the Aussie dollar improves? Am I better off sticking to the ASX until the Aussie dollar is closer to parity with the US dollar? And this is what we're talking about at the top of show, Drew. You mentioned this. The Australian dollar has fallen. I think it's around 64 cents from memory. It's just off the top of my head. So the question is, if you invest that money, like say you got 10 grand, you invest that in the United States, you're going to get, 6,400. But then the Australian dollar rallies. All of a sudden, your US dollars are worth less if you were to convert them back. How are you thinking about this? Given also that US shares have rallied strongly this year, like the NASDAQ's up 35% this year.
I mean, what we always try and do for focusing on retirement capital is how do you remove a risk from it? So buying, call it naked US stocks, unhedged at the moment, is exposing yourself to that risk. What I would say though is that doesn't mean you just focus on the ASX. like the two-pronged question. If you focus on the ASX, you're giving up the exposure to companies that we're talking about, Microsoft, Tesla, Alphabet. So are there ways you can be buying and still getting your exposure overseas, but without having that open currency risk by buying direct stocks in another currency? And that's where things like ETFs and managed funds come in. So understanding that the drivers of returns over long term are still going to be global equities and Australian shares, and not just putting it all into local shares. And yeah, don't expose yourself to that extra risk. You're not going to be able to predict where interest rates are going to go, but the last thing you want is we know the Australian dollar swings heavily when it swings.
Yeah. Yeah. Well said. I'd say that, we've seen the US stocks. Like if you're just in an index fund, say S&P 500, you've got a 15% return this year. There's a chance with Aussie stocks going nowhere this year that your portfolio may be out of balance and it might need to be rebalanced. And I think it's, like you said, removing the risk of currency. By rebalancing, you're doing that as well. So
Buying low, selling high.
yeah, exactly. So that may be the strategy, to take a top-down approach on it, and to just kind of get a plan in place before you kind of just guess. I'd say waiting for the Aussie dollar to go back to parity. I could be mistaken, but I think it's only ever been there once or twice. So I'm just going to quickly look this up. I think it's only ever been there once or twice. So I wouldn't.
Twice in my lifetime.
Yeah, so it was
long,
there.
long lifetime.
So it was there in 2010 to 2013. And then you'd have to go back well before 1998, as far as I've got my charts right here, to see that. So I think for the most part, yeah. So when was it back parity again? Even Yahoo Finance doesn't have the chart. So it's a long way back.
We just remember that there was that iron ore massive boom that had us like beyond parity for a long period of time.
Yeah, and that was in the 2012 period. So Professor Rask and Dr. Andrew Meredith, who says, what is the best data service to view financial reports such as balance sheets, income statements, and cash flow statements? We'd be keen to understand what Owen uses if possible. Morningstar provide all the data in full exportable Excel sheet format. However, are there alternatives which may be more cost effective, or other services I can consider? I can tell you, yeah, for sure. It's Tikr, so TIKR.com. Tikr is the service that I use for all financial statements. But let's be real, when we're doing investments, when we're making investments in the companies or modeling, we never rely on any data source. We do it all ourselves. You just go into the primary source documents and you get all of the numbers out yourself. So we use Tikr just simply for a visual effect and understanding at large what's going on, for screening, that sort of stuff. And we use Morningstar.com for analyst reports on individual companies. It also provides some useful info on ETFs and funds and that sort of stuff. But that's it. There are other alternatives like Koifin for financials. You can use Whale Wisdom for finding out what global investors are doing. You can use, at the lower end, you've got Simply Wall Street, which uses good data, but it's a different type of tool.
I think
so there are many.
FactSet maybe, but that's a professional tool.
Yeah, FactSet, Bloomberg, they're all professional tools, whereas Tikr's kind of bringing that same institutional grade data and quality. I think you can get it for about $25 US a month. I could be wrong there, but that's the one. So TIKR.com. Good question. Golden Oldies has asked a very big question. I was listening to the Peter Schiff podcast and wondering, with the American economy and the American debt being so high and ever growing and no stopping, do you think the USA will ever pay back its debt? Is the American government likely to devalue its dollar? I heard that IMF now classes gold as a form of payment. Is it likely that it will pay it back in gold after its devaluation and use gold to settle its debits? This is a very big question.
This is the age-old question.
This is a
Go
very
back to the
big
gold
question.
standard, and then you have to remember why the gold standard was broken.
Yeah. Dr. Andrew Meredith, over to you. Resident.
Who broke the gold standard? That was when central banks, every dollar in your central bank had to be backed by gold, and then they realized it actually,
it's not plausible.
Matter. Yeah, it was actually impossible, and the cost of goods and everything would just fluctuate too much, and literally it's the whole concept of fiat money. This is a Bill Mitchell. If I get this wrong, Bill Mitchell is going to be on the emails, and I know another client of mine, Fred, will be calling first thing if I get this wrong. But no, the US government does not ever have to pay back its debt. It needs to redeem or pay back bonds as they mature, but it can simply issue more bonds. And in the very, 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 very worst case, the Federal Reserve would just essentially buy the bonds from the Treasury, as it has for the last 15 or 20 years. So it does not have to pay back the debt. And this is I'm getting myself into trouble, and there's a rabbit hole here. But what you're
surely,
probably
Drew,
talking about is financial repression. And it's kind of what's happening at the moment. So the idea that as inflation continues to increase, the tax takings from the government will also increase, and they'll be able to more aggressively pay back the debt. And it's what's supposed to happen to balance the economy. And that's probably with the comment around the IMF that we had at the beginning, that if too much money is going to the economy and there's deficit, it creates inflation, not necessarily the people spending, but government spending. So how do you start reversing that? And maybe it's naturally happening because the interest costs are going up, but then you're just issuing more bonds to do it. So I'm in a rabbit hole.
Here's
And I
spiraling.
don't think we're going back to a gold standard. Like, there's a story that you could make $1 trillion bill tomorrow, all the government debt would be gone, and that $1 trillion bill would not be inflationary. It'd probably be deflationary.
I think this is like it's very easy for people to get overwhelmed and think that a government's balance sheet, at least one where they print their own currency, is like a household balance sheet.
I'm playing Thatcher for that.
But the easiest way to think about it would be that imagine you have your household balance sheet and you can just go and click the button in the kitchen and you just get more money. And the debt keeps expanding, but you just keep clicking the button and you just keep going. Of course, there's more to it, but that's just the general gist. All right, we've probably got time for maybe 2 more questions. Well, it's good. There's only 2 more questions left.
I cut and paste that question for when Bill Mitchell's on.
Okay, yeah, we'll just put it to him, but we'll change a few words and just see if we can just mix it up and just throw a few spanners in there. Hopefully he's not listening. Ian McCoon writes in, and it's not the actual Ian McCoon, says, you mentioned Magellan suffered from a key person risk, which had a big impact on the share price when they left. Do you think Pinnacle, ASX P&I, also is at risk of this? Given Ian McCoon, he said he would likely leave around 2023. Thanks. So just so we can confirm, Pinnacle is like an investment manager. Yeah, but they have multiple brands. I counted them before we came on here. I can't remember how many. It's like
12.
10 plus. So they've got a couple like private equity type things in there. But so they've got 10 different strategies or fund managers beneath them, and they own a part of all of them. Rather than Magellan, which at the time, with Hamish Douglas at the top, really only had one like key person overseeing a few of the strategies, which was they have the infrastructure, which kind of the team kind of sits off to the side, is really good. But the main global fund was run by the talisman, Hamish Douglas. Now Magellan have the core series, Airlie, still got the global fund and infrastructure, but it's very different to Pinnacle in that Pinnacle doesn't have to manage the money of all of the different strategies. It just has to market and sell them and promote them to financial advisors. So I would say, Drew, it's a very different thing. Even if you step back, I think the key person risk is not nearly as profound. That would be
I think Hamish Douglas was the key decision maker for individual investment decisions, as well as running the Magellan business. And that's where we see key person risk, is in it was all his IP that was driving performance. Whereas at Pinnacle, you've got the complete opposite. It's all these individual managers. I think Metrics is in there. So Andrew Lockhart, I think Firetrail's in there. Some of those groups. Yep. So they've got their own key person issues within each fund, but not necessarily the top level. That not discounting Ian McCoon's importance. I'd suggest that the company has run incredibly well because of his leadership at that managing director level of Pinnacle, but not the individual managers. So the performance of I think the performance of this company is driven by the performance of the managers over the long term, and selecting those managers well.
So, Drew, there's two more questions, which will be quick on. We'll give 30-second answers to both. But this one here from Lee, which was, hi, Owen, I watch your YouTube live every Wednesday. I would love to hear your views on STX and also explain why BHP is half the price of Rio, but is the biggest mining company. Well, that's just because you're thinking about share prices, and Rio Tinto has fewer shares on offer than BHP. So it's like you get a $10 pizza, You can cut it in half. You got 2 $5 slices, or you can cut it in 5 pieces. You got 5 $2 slices. It doesn't really matter how big the slice, how expensive the slice is. It's how many slices there are that matter, and that's how you work out the value of a business. So BHP is the bigger business. STX is a business that I was unfamiliar with. It's Strike Energy, ASX, ticker symbol STX. And as far as I know, the company has made close to nothing in receipts from customers because it's an oil and gas exploration company. It made $32,000 of receipts from customers in the first 3 months of the year. It went backwards to the tune of $23 million. And that's because it's early stage. It's a business that, despite having a large market cap, it's very, very early stage. It's not the type of business that I invest in any sense of the word. So it's too early stage for me, and I imagine the same is for Drew. The question I've got for you, Drew, which I didn't know the exact answer for this, and I was trying to think about this one just quickly, which is from Devastated Mortgage Prisoner, which is a hell of a name. How do I claim a capital loss on OpenPay shares? For those that don't know, OpenPay went out of business. It was, as far as I know, it was a buy now, pay later business, went out of business, which was on the ASX. Do you have to wait until the final decision is made that your equity is virtually worthless?
I had the same question. A couple of clients had companies that eventually disappeared, but it can take like 2 or 3 years for that administration process. And they found, so again, not a recommendation, but there's a group called delisted.com.au where you can search old companies, old codes, and they actually buy those shares from you. You usually have to pay them to do it, but it gets the capital. It realizes that capital loss. I'm not sure what they do with them. Maybe they use it to negotiate or try and get some value of the assets at the end. But you can sell it to crystallize that loss to a group, whatever delisted is or what they do behind the back. I have no idea, and that's not a recommendation.
Yeah. It's interesting because, it'd be interesting. Go to delisted.com.au. We've spoken about this a little bit before, but go and check that out because when a company does go into liquidation or administration, it's not every day. People think that happens quite a bit in the stock market. It doesn't actually happen that often. Like most people sell it before it gets to that point. But I would say you've got to realize the loss. So I'm sure delisted. I've been on the website. We'll have more information. All right, Drew, we've got to pick a best question to name. I'm actually going to go with that one. Devastated Mortgage Prisoner, because it's just grabs me right in the back of the throat there. Devastated Mortgage Prisoner, if you did write into us, if you could write into us, that'd be great. Just tell us that you were the questioner and you'll get a free pass to the Value Investor Program. Drew, we've got to get sent off into the distance with a good old dad joke. The dad joke lit up on Instagram the other day. But before we get to that, people can head to the link in the show notes. This is financial planning to get in touch with Wattle Partners, the team, including Drew. So you can do that there. You can say good day to us as well. Drew, what have you got for us?
All right. As always, unprepared and ready to go now.
Great.
What do you call a factory that makes okay products? Probably a link to Pact Group Holdings. I mean, maybe not.
Okay products. I don't know.
A satisfactory. That's the laugh I get when I say credit to you. So no credit to me.
I feel like that nothing's coming close to your fish in the riverbank quote.
It was a setup for that one that worked.
Yeah. You're gonna have to come back with a bit more than that, mate. I'll give you a 5 out of 10 because I'm being generous. But that was good, mate. Well, next week we'll be back to answer questions. Send us your questions via the link in the podcast player or in the YouTube description. Drew Meredith from Wattle Partners, as always, mate. Absolute pleasure.
Good to see you.